Canada lost 18,000 jobs in April, and the unemployment rate rose to 6.9%. But in the U.S., employers added 115,000 jobs in April, following an initial surge in March, while the unemployment rate held steady at 4.3%. Here to tell us more is Sonu Varghese, Chief Macro Strategist at Carson Group. And it's great to have you join us. Thanks so much.
Thank you for having me.
Let's start with the U.S. numbers, because we haven't really talked about that yet this morning. I mean, it looks like a pretty rosy picture here. What exactly stood out to you in this report?
I think just the stabilization of the labor market. I think coming into this year, everyone was worried about downside risk for the labor market. We were always in the camp that the labor market probably looks better than the headline payroll numbers were suggesting, because payrolls have been going up and down for 10 months consecutively. And now we've got 2 back-to-back months with positive payroll gains. Over the last 3 months, payrolls have averaged about 48,000, which normally wouldn't be great. But now, with population growth really stalling, especially amidst the immigration collapse, the economy doesn't need to create as many jobs to keep the unemployment rate steady. And the unemployment rate is at a historically low level of 4.3%. So the job market looks fairly healthy right now.
That's very interesting. I mean, I was going to ask you, like, what does this signal about the job market more broadly? Because as you say, there's less jobs and less people, and that's why we're seeing these numbers today.
Exactly. And another metric I like to keep track of is the prime age, which is 25 to 54, employment population ratio. That's at 80.7%. That is the highest we've seen at any point, over the last 25 years, except for a short period in 2024. And it's higher than at any point in the 2000s expansion or even the 2010s expansion, which tells you essentially more people in their prime working age years as a proportion of the population. There were more people working now than at any point in the last 2 expansions. That tells you that the labor market is holding up. And despite low job growth, things are probably looking okay.
On the flip side, though, maybe not the same picture painted in Canada, it seems. We've lost more than 17,000 jobs in April. What does this say, do you think, about the Canadian job market at the moment?
I think with Canada, and to tack on to that, Canada's lost about close to 112,000 jobs year to date. That is the steepest 4-month drop since January of 2021. And the unemployment rate is at close to, I believe, a 6-month high of 6.9%. That's what the unemployment rate was in April. Look, Canada's economy is highly levered to exports. I think over a third of GDP, somewhere around there, is exports. And with all the tariff noise and trade uncertainty with the U.S. is the biggest export partner, no surprise. I think that's hitting parts of the Canadian economy. And the other side, but counter to that, is the crisis in the Middle East, raising oil prices. That's obviously good for parts of the Canadian economy, especially the petroleum oil sector. On the other hand, that leads to higher inflation as well. And exports are not just oil and petroleum products, right? You have Canada exporting things like cars and consumer goods and all sorts of things. So I think it's the potential slowing of the global economy. If the Middle East crisis continues, that's probably weighing on the Canadian economy and the labor market too.
And with that in mind, would rising gas prices influence unemployment rates moving forward in both countries?
I think it hits real incomes. So the labor market, from a U.S. perspective, wages are growing okay. Wages are growing close to trend. Wages are growing close to the pace we saw pre-pandemic, which is a pretty strong labor market. The problem is inflation is much higher. Inflation's running above 3%, maybe close to 4% now with higher energy prices. That squeezes real incomes. But for now, what's happening, consumption is continuing, especially nominal consumption, and that's because consumers are saving less. Essentially, that's how they're funding consumption. That's why consumption's still strong. And we see that continuing for the time being, especially with the markets hitting all-time highs, as you pointed out at the top. There's a wealth effect as well. So people feel like, okay, we've got, we can afford to maybe save a little less because our portfolios are doing better.
Going back to the U.S., what are you seeing in the U.S. GDP right now?
Here's where there's a difference between real GDP growth and nominal GDP growth. Real GDP growth is probably running below trend. Let's say trend is about 2.5 2.7%. Real GDP growth, we are seeing close to 2%. And I don't think that's a big surprise because inflation's weighing on real activity. But nominal GDP growth is running above trend. Trend is about 4% thereabouts. Nominal GDP growth is running about 5 to 6%. Now, that's what actually matters for the stock market because revenues and profits come from nominal GDP growth. And if you look at earnings season, companies are clocking in an average growth rate of earnings of about 27% year over year. That's a result partly of strong nominal GDP growth, but also margin expansion.
Where do you think that points to then in terms of decisions for rate cuts, rate hikes, holding rate steady moving forward?
Look, with the backdrop of a fairly okay labor market here in the States, but elevated and rising inflation, normally I think we'd be talking about potential rate hikes. But with the new incoming chair, Kevin Warsh, I think the Fed's going to stay steady. They're not going to hike rates. They're not going to cut rates either. We've been in the camp here at the Carson Group saying we don't expect rate cuts this year. But at the same time, I don't think we are expecting rate hikes as well. What does that mean? That means while inflation's rising, while inflation stays elevated, the Fed stays easy. That's looser policy. That's another tailwind for equity markets.
I guess another key question going forward, I think you touched on this off the top, but I wanted to ask you directly, like the Iran war, it's already been prolonged. If it continues, will that also start to weigh on hiring moving forward in both Canada and the U.S.?
I think ultimately it will weigh, especially if inflation continues to weigh on real incomes. The longer the crisis goes on, the more likely it is that inflation stays elevated. Mm-hmm. And then I could see a situation in which central banks in both countries start to worry about inflation expectations getting out of hand, and we could see rate hikes potentially. And I think the path to, maybe job losses, continuous job losses here in the States with the unemployment rate going up, lies through the Federal Reserve hiking rates. I think that's the danger here. If the crisis continues for much longer and oil prices go up to, let's say, $120 a barrel and remains there.
And then just lastly, very quickly, at the same time, big tech companies like Meta, Microsoft, you say, are kind of reducing their headcount?
They are, I think, partly because they're investing more. They're spending so much on AI-related CapEx. So you see this in cash flows reducing, headcount reducing as well. I don't think it's solely because we are implementing AI, we are seeing headcounts reduce. I think it's just a straight out fact that they're spending more money on CapEx. That's where they think growth is and where they have to compete. And that's why we are seeing profits also rise. One company's spending is another company's profits, and that's what's boosting earnings, especially in the tech sector.
So interesting to kind of get the story behind these numbers. Okay, Sonu Varghese, Chief Macro Strategist at Carson Group. Appreciate you joining us today. Thank you.